Chapter 14 Basic Tools of Finance. These are the questions we seek answers to. What is the present value? How can we use it to compare sums of money from different times? Why are people risk averse? How can risk averse people use insurance and diversification to manage risk? What determines the value of an asset? What is the efficient markets hypothesis? Why is beating the market nearly impossible? So, finance. The financial system coordinates savings and investment. That's the function of the financial system. Participants in the financial system make decisions regarding the allocation of resources over time and the handling of risk. Finance, therefore, studies how people make decisions regarding the allocation of resources over time and the handling of risk. Concept of present value. The present value of a future sum is the amount of money today, PV, needed to produce a future amount of money, FV, given prevailing interest rates. The future value of money. This is the amount of money in the future, or FV, at an amount of money today, that an amount of money today, PV, will yield given prevailing interest rates. Example 1, Grandma's gift. Marcus received $200 from Grandma for his birthday. He wants to deposit the money in the bank at 5% interest. What is the future value, or FV, of this amount? So the present value is 200. The interest rate is 5%. In 1 year, future value is 200 times into bracket 1 plus 0.05, which is equal to 210. In 2 years, it is FV is equal to 200 times into bracket 1 plus 0.05 raised to power 2 is equal to $220.50. What about in 3 years? Future value is 200 times 1 plus 0.05 raised to power 3 is equal to $235.53. In n years, the future value is PV for present value times into bracket 1 plus R raised to power n. Example 2, how much to save? Amaya inherited money from her aunt's estate. She wants to travel for now, but also to save some of the money to pay for graduate school in 4 years. If the interest rate is 8%, how much does she need to deposit today to have $20,000 in 4 years? We need to find present value of $20,000, which is the future value, when interest rate is 8% or 0.08 and n is 4. We know the formula. Future value, or FV, is equal to PV plus into bracket 1 plus R raised to power n. So present value equals future value over into bracket 1 plus R raised to power n. So present value is therefore 20,000 over 1.1 plus 0.08 raised to 4, which is equal to $14,760. $14,700.60. Compounding and the rule of 70. Compounding is the accumulation of a sum of money where the interest earned on the sum earns additional interest. Because of compounding, small differences in interest rate leads to big differences over time. The rule of 70. If an amount grows at a rate of X% per year, that amount will double in 70 divided by X years. Example 3, compounding and the rule of 70. You buy $1,000 worth of Microsoft stock and hold it for 30 years. If rate of return is 0.8, and also if rate of return is 0.1. When rate of return is 0.8, the future value is $10,063. The 1,000 will double in 70 over 8, which is 8.75 years. If the rate of return is 10% or 0.1, future value equals 17,450. The 1,000 will double in 70 divided by 10, which is 7 years. Thus, a 2% increase in the rate of return from 8% to 10% leads to over $7,000 of additional interest earned over the 30 years. Example 4, investment decision. Pacific Gas and Electric wants to build a new power plant that will generate $800 million in 10 years. The plant costs $400 million to build. Should PG&E build the plant? If number A, interest rate is 4%, why? What about number B? Interest rate is 8%. Why? We need to find present value of 800 million in 10 years. Number A, present value equals 800 million divided by 1.04 raised to power 10 is $540,451.30. Since cost is less than present value, PG&E should build it. What about B? The present value of $800 million divided by 1.08 raised to 10 power 10 is equal to $370,544.80. Since cost is greater than present value, PG&E should not build it. Active learning. Buying land to sell later. Michaela is thinking of purchasing a 12-acre lot for $70,000. The lot will be worth $120,000 in 10 years. Number A, should Michaela buy the lot if interest is 0.03? Or number B, should Michaela buy it if interest is 0.07? Number A, present value is 120,000 divided by 1.03 raised to power 10. And that is $89,291.27. Since the price is less than the present value, Michaela should buy it. What about number B? Present value is 120,000 divided by 1.07 raised to power 10 is equal to $61,001.92. Since price is greater than the present value, Michaela should not buy it. Risk aversion. Most people are risk averse or they don't like uncertainty. People dislike bad things happening to them. Utility. Utility is a person's subjective measure of well being or satisfaction. Diminishing marginal utility help explain why most people are risk averse. Let's look at a utility function with a diminishing slope. The utility is measured on the vertical axis, wealth is measured on the horizontal axis. If you lose $1,000, utility loss from the losing $1,000 is this distance. If you gain $1,000, utility gain is smaller than the loss. As you can see, the green area is smaller than the brown area. Diminishing marginal utility. The $1,000 loss reduces utility more than the $1,000 gain increases it. So losing hurts more than the pleasure that you gain from winning. Managing risk with insurance. How insurance works. A person facing a risk pays a fee to the insurance company, which in return agrees to accept all or part of the risk. Insurance allows risks to be pooled and can make risk averse people better off. Two problems in insurance market. Number one, adverse selection. A high risk person benefits more from insurance, so is more likely to purchase it. People with chronic illnesses have more incentive to buy health insurance provided it covers their treatment than other people. Number two, moral hazard. People with insurance have less incentive to avoid risky behavior. People with good fire insurance have less incentive to replace the batteries in the smoke detectors. Active learning 2. Adverse selection or moral hazard. Identify whether each of the following is an example of adverse selection or moral hazard. Number A, Jeremiah begins smoking in bed after buying insurance. Number B, both of Chloe's parents lost their teeth to gum disease, so Chloe buys dental insurance. Number C, when Aaliyah parks her Corvette convertible, she doesn't bother putting the top up because her insurance covers theft of any items left in the car. Diversification of firm-specific risk. Standard deviation. Standard deviation measures the volatility of a variable. Diversification. The reduction of risk achieved by replacing a single risk with a large number of smaller unrelated risks. Diversification can eliminate firm-specific risk affecting a risk that's affecting a single company, but does not affect or does not eliminate market risk. Market risk is a risk that affects all companies in the stock market. This is a graph that shows how to reduce risk through diversification. Risk declines as you increase the number of stocks in the portfolio. And increasing the number of stocks reduces farm-specific risks, but the market risks does not reduce. Trade-off between risk and return. Trade-off riskier assets pay a higher return on average to compensate for the extra risk of holding them. Over the past 200 years, average real return on stocks is about 8%, which is for riskier assets. On short-term government bonds, which is less risky, is 3%. Example 4, the risk-return trade-off. In this graph, the percent is measured on the vertical axis and the risk or the standard deviation is measured on the horizontal axis. Portfolio with two assets. Number A, or a diversified group of risky stocks with an average return of 8% with a standard deviation of 20. A safe asset with a return of 3% but a standard deviation of 0. As you see, the increased return varies directly with increased risk. Increasing the share of stocks in the portfolio increases the average return, but also the risk. Asset valuation. When deciding whether to buy a company's stock, you compare the price of the share to the value of the company. Stocks are undervalued if price is less than the value, overvalued if price is greater than the value, fairly valued if price is equal to value. Active learning 3, valuing a share of stock. If you buy a share of AT&T stock today, our return is 0.1, you will be able to sell it in 3 years for $30. You will receive a $1 dividend at the end of each of those 3 years. What is the value of the share of AT&T stock today? One amount you will receive, future value is $1. When you will receive it in 1 year, the present value is 91 cents. The second year, you receive $1. You will receive it in year 2. The present value is 83 cents. The third year, you got another $1 in dividend, and the present value for that will be 75 cents using the formula, of course. In the end, after 3 years, you get back the $30. The present value of that $30 is 22.54. The sum is you add all the three, and the present value is $25.03. Valuing a share of stock. Asset valuation 2. Value of a share is equal to the present value of all dividends the stock will pay, plus present value of the price you get when you sell the share. Problem. When you buy the share, you don't know what future dividends or price will be. So, the fundamental analysis, which is one way to value stock, the study of a company's accounting statements and future prospects for determining its value. Active learning 4, show of hands survey. You have a brokerage account with Merrill Lynch Wealth Management. Your broker calls you with a hot tip about a stock. A new information suggests that the company will be highly profitable. Should you buy the stock in the company? Number A is yes, number B is no, number C, not until you read the prospectus. Number D, what is the prospectus? Now you got to think through this. Efficient market hypothesis one. Efficient market hypothesis, or EMH, is the theory that asset prices reflect all publicly available information about the value of an asset. Each company listed in a major stock exchange is followed closely by many money managers. The equilibrium of supply and demand sets the market price. Efficient market hypothesis too. Stock market exhibits informational efficiency. Each stock price reflects all available information about the value of the company. Stock prices should follow a random walk, which is the path of a variable whose changes are impossible to predict. If prices reflect all available information, no stock is a better buy than any other. The best you can do is to buy a diversified portfolio. Ask the experts. Diversification. In general, absent any inside information, an equity investor can expect to do better by holding a well diversified, low fee passive index fund than by holding a few stocks. And 100% agree. Market irrationality. Many believe that stock price movements are partly psychological. J.M. Keynes in the 1930s, stock prices are driven by animal spirits of investors, irrational waves of pessimism and optimism. Alan Greenspan in the 1990s stated that stock market boom was due to irrational exuberance. Speculative bubble, which is the price of an asset rises above what appears to be its fundamental value. The possibility of speculative bubbles is the value of a stock to a stockbroker depends on a stream of dividend payments and the final sale price. Debate frequency and importance of departures from rational pricing. Market irrationality. The movement in stock market is hard to explain news that alter a rational valuation. Efficient markets hypothesis. It is impossible to know the correct rational valuation of a company. Think, pair, share. When your parents visit you at the college, they find you throwing dirt at stock pages on your bulletin board. You received an enormous signing bonus from the company you will work after graduation. You are now in the process of picking the stocks in which you plan to invest. Your father says there's got to be a better way to choose stocks. I can give you the phone number of my stock analyst, or you could at least buy a well known, well managed mutual fund. Number A, what is the stock valuation method to which your father is referring and what is its goal? Number B, explain the efficient markets hypothesis to your parents. If it is true, can your father's method of picking stocks achieve its goal? Number C, If the efficient markets hypothesis is true, what is the only goal of your dart throwing exercise? Explain. Number D, if the efficient markets hypothesis is true, which of the following will likely provide the greater return in the long run? Your dart throwing exercise or an actively managed mutual fund? Why? Chapter in a nutshell. Because savings can earn interest, a sum of money today is more valuable than the same sum of money in the future. The present value of any future sum is the amount that would be needed today, given prevailing interest rates, to produce that future sum. Because of diminishing marginal utility, most people are risk averse. Risk averse people can reduce risk by buying insurance, diversifying their holdings, and choosing a portfolio with lower risk and lower return. The value of an asset equals the present value of the cash flows the owner will receive. For a share of stock, these cash flows include the stream of dividends and the final sale price. According to the efficient markets hypothesis, financial markets process available information rationally, so a stock price always equals the best estimate of the value of the underlying business. Some economists question the efficient markets hypothesis, however, and believe that irrational psychological factors also influence asset prices.